In its October resolution, the Monetary Policy Committee took a calibrated policy judgment of a reduction of 25 basis points in the policy repo rate on the basis of its assessment of the inflation path for the rest of the year, based on the information available up to August and high-frequency indicators in September. Inflation outcomes in September and October, as well as the latest projections for Q4 2016-17, vindicates this stance. It may be recalled that in October, the MPC envisaged a trajectory taking headline inflation towards 5% by March 2017, with risks tilted to the upside. Since then, a couple of risks have waned. One, the disbursement of salaries and arrears under the 7th Pay Commission's award has not been disruptive to inflation outcomes. Two, the extension of 2 months given to the Ministry of Finance to issue the notification on higher allowances under the Commission's award could push its fuller effect into the next financial year rather than this financial year. The committee felt that it is now important to ensure that the targets of 5% for Q4 of 2016-17 and of 4 plus or minus 2% for the medium term are achieved. This assumes critical importance in view of the stickiness in inflation, excluding food and fuel, what we call core. The recent rising profile of international crude prices and the continuing firmness in the prices of some salient food items. Accordingly, the MPC was of the view that given the reduction of the policy rate of 25 basis points in October, which cumulated to a reduction of 175 basis points since January 2015, a further reduction in the policy rate is not warranted at this juncture. It may be recalled that an incremental CRR was applied on banks' increase in net demand and time liabilities between September 16 and November 11, as part of our liquidity management operations to manage the return of specified banknotes into the system as deposits. This was intended as a purely temporary measure to manage the transition from an exclusive reliance on LEF operations to a mix of instruments, including the MSS issuances. The government has proactively responded to the situation by enhancing the limit of MSS securities to 6 lakh crores or 6 trillion rupees. This has enabled the withdrawal of the incremental CRR with effect from the fortnight of December 10th. Banks will no longer have to bear the burden of the incremental CRR, as they will be adequately compensated through the coupons on MSS securities.